BlackRock, the name itself, evokes images of formidable strength and impenetrable mystery. In the labyrinthine world of finance, BlackRock stands as a behemoth, its influence reaching far and wide. As the world's largest asset manager, it oversees a staggering pool of wealth, managing trillions of dollars on behalf of its clients. Founded in 1988, BlackRock's ascent has been meteoric, transforming from a small team into a global powerhouse with offices in over 30 countries. Unlike traditional investment banks, BlackRock focuses on managing investments for its clients, which include pension funds, sovereign wealth funds, and high net worth individuals. These clients entrust BlackRock with their capital, seeking to grow their wealth and secure their financial futures. BlackRock's vast scale and influence have earned it both admiration and scrutiny. Its supporters hail it as a stabilizing force in the global economy, providing essential investment services. Its detractors, however, view its immense power with suspicion, questioning its impact on market fairness and corporate accountability. To comprehend BlackRock's influence, one must grasp the sheer magnitude of its assets under management, or AUM. In BlackRock's case, that figure has soared to unprecedented heights, exceeding $10 trillion in recent years. This colossal sum reflects the trust that investors worldwide have placed in BlackRock's ability to generate returns and manage risk. BlackRock's AUM is spread across a diverse range of asset classes, including stocks, bonds, real estate, and alternative investments. This diversification allows BlackRock to mitigate risk and tailor investment strategies to meet the specific needs of its clients. The sheer size of BlackRock's AUM grants it significant leverage in financial markets. When BlackRock makes an investment decision, it has the potential to move markets, influencing the price of assets and impacting the returns of other investors. This influence is further amplified by BlackRock's reputation as a sophisticated and well-informed investor. While BlackRock does not directly control the internet, its influence on the digital realm is undeniable. As a significant shareholder in many leading technology companies, including Apple, Microsoft, and Amazon, BlackRock wields considerable sway over the tech industry. As an active investor, BlackRock engages with the management teams of its portfolio companies, providing feedback on their strategies and advocating for policies that align with its interests. This engagement can take many forms, from private meetings with executives to public statements on corporate governance issues. BlackRock's influence is particularly pronounced in shareholder meetings, where its votes can determine the outcome of critical decisions. The firm's voting power stems from its vast shareholdings, giving it a significant say in the governance of its portfolio companies. While BlackRock's influence on the internet is indirect, it is nonetheless pervasive, shaping the online experiences of billions worldwide. BlackRock's influence extends beyond technology into critical infrastructure projects, as evidenced by its joint venture with AT&T and Gigapower. This ambitious endeavor aimed to roll out high-speed fiber optic internet access to millions of homes and businesses across the United States. However, the project has been marred by allegations of worker exploitation and safety concerns, raising questions about BlackRock's commitment to responsible investment practices. Gigapower, a 50-50 partnership between BlackRock and AT&T, promised to bridge the digital divide by providing fast and reliable internet access to underserved communities. The project's potential societal benefits were undeniable, offering improved education, healthcare, and economic opportunities. However, reports from labor organizations and investigative journalists painted a different picture. The Communications Workers of America accused Gigapower of prioritizing cost-cutting measures over worker safety and well-being. These allegations raised concerns about BlackRock's role in the project. Critics argued that BlackRock's pursuit of profits had come at the expense of the very workers responsible for building the infrastructure. Section 5. Aladdin, the Oracle of Investments. Central to BlackRock's dominance in the financial world is Aladdin, its proprietary risk management and investment technology platform. This sophisticated software, short for Asset, Liability, Debt, and Derivative Investment Network, has become an indispensable tool for BlackRock and its clients. Aladdin's algorithms process vast amounts of data from multiple sources, generating complex financial models that assess risk, identify investment opportunities, and optimize portfolio allocation. Aladdin's ability to analyze massive data sets and generate actionable insights has made it a game-changer in the world of finance. BlackRock's reliance on Aladdin has raised concerns about the potential for algorithmic bias and the concentration of power in the hands of a single firm. Critics argue that Aladdin's algorithms, while sophisticated, are only as good as the data they are trained on. If this data is incomplete, inaccurate, or biased, it could lead to flawed investment decisions with far-reaching consequences. Despite these concerns, Aladdin remains a cornerstone of BlackRock's success, solidifying the firm's position as a leader in the global asset management industry. Section 6. Dispelling the myths, BlackRock and conspiracy. BlackRock's immense size and influence have made it a target for conspiracy theories, from market manipulation to controlling governments. One myth claims BlackRock is buying all the real estate, driving up prices. In reality, BlackRock invests on behalf of clients like pension funds. Another theory accuses BlackRock of rigging elections, but there's no credible evidence. BlackRock is subject to strict regulations and disclosure requirements. The company denies electoral manipulation, focusing on lobbying relevant issues. Approach these theories critically and rely on credible sources. Distinguish between legitimate concerns and unfounded accusations. Section 7. The Climate Conundrum. In recent years, BlackRock has faced growing pressure to align its investment portfolio with the goals of the Paris Agreement and to address its role in financing climate change. CEO Larry Fink's annual letter to CEOs has increasingly focused on the importance of sustainability and the need for companies to address climate risks. In his 2020 letter, Fink declared that climate risk is investment risk, arguing that companies that fail to adapt to a low-carbon economy will face declining profits and diminished valuations. He urged companies to disclose their climate risks and to develop credible plans to reduce their carbon footprints. Some environmental groups have praised Fink's leadership and BlackRock's commitment to sustainable investing. Others, however, have criticized the firm for not going far enough, arguing that BlackRock continues to invest heavily in fossil fuel companies. BlackRock's approach to climate change highlights the challenges faced by large institutional investors in balancing their fiduciary responsibilities with the need to address global challenges. Section 8. The Real Impact, a Nuanced Perspective. BlackRock's true impact on the world is far more nuanced than the simplistic narratives often presented in the media. While the firm's immense size and influence are undeniable, its role is not that of a shadowy puppet master controlling the global economy. Rather, BlackRock operates within a complex web of market forces, regulatory constraints, and competing interests. BlackRock's primary objective is to generate returns for its clients, which include pension funds, insurance companies, and sovereign wealth funds. These institutions entrust BlackRock with their assets, seeking to grow their wealth and achieve their financial objectives. However, BlackRock's actions also have broader societal implications. Its investments in infrastructure, technology, and energy shape the world we live in. As a powerful actor in the global economy, BlackRock has a responsibility to use its influence wisely and to consider the broader societal impact of its decisions. Section 9. The Future of Power, a Call for Scrutiny. BlackRock's dominance in the financial world raises important questions about the concentration of power in the hands of a few large asset managers. As these firms continue to grow in size and influence, it is crucial to ensure that they operate within a framework of transparency, accountability, and public scrutiny. Governments and regulators have a critical role to play in overseeing the activities of large asset managers and in mitigating the risks posed by their dominance. This includes strengthening financial regulations, enhancing disclosure requirements, and promoting competition in the asset management industry. Investors also have a responsibility to hold BlackRock and other large asset managers accountable for their actions. The future of finance will be shaped by the decisions of large asset managers like BlackRock. It is up to all stakeholders to ensure that these firms use their power responsibly and in a manner that benefits society as a whole.